The first thing I wanted to go over today is a bit of emotional temperature taking. Whenever gold and silver, especially silver, is in a rut, which it's in now, we all feel negative. Now, that is not a problem. It is normal, it is natural, it's healthy to feel negative when things are not going your way. What is a problem is to feel so negative that you're scared and freak out, that you do rash things or get too scared or cannot function or cannot see rationality clearly. And that generally is not a function of the kind of emotional person you may be, because that can be regulated with the amount of cash levels that you have, which is why I advise in my subscriber service, the Endgame Investor, to always picture the worst possible scenario for your investment portfolio. And when you picture that and imagine what you'll be feeling like if that happens, if you feel only annoyed or perturbed or disappointed, then you're fine. If you feel a little bit stressed out and possibly slightly worried, that's also fine. But if you're so financially stressed and so leveraged that you can no longer be in this game, that is the problem. This game, if you're playing it, is a game of emotional balance. If you're a pure stacker, you should have no problem, because I'm sure if you're just a pure stacker, you're not threatened and feeling that you have to sell your stacks right now. As long as you can regulate your own emotional health, you will win this game. And most people cannot, which is why most people lose, even if they're right on the long-term objectives. Let's get into our first topic today, which is actually mortgage-backed securities, the housing market, and how it's related to the dollar. Today's silver report is brought to you by Fortuna Silver Mines, which I own and which I plan to continue to own for the long haul. It always helps to take a look at their profit margins and how much it costs for them to produce the silver and the gold they produce. So here's a good overview if you're interested in this miner. These are their most productive mines: the San Jose mine in Mexico, with an all-in sustaining cost of between $13.7 and $16.1 per ounce. Loma maximum 21.1. And for gold, we have a maximum of $1,100 an ounce for the Lindero mine and a maximum of $1,650 an ounce for the Yaramoko mine in Burkina Faso. If we believe that gold and silver are testing their lows now, which it seems pretty likely that they are, then the profitability of Fortuna will only rise as the years pass. And especially if we do encounter a crack-up boom, as I believe we will. Take it away, PowerPoint. This graph from Statista is the total mortgage-backed securities outstanding in the United States since 2000. I don't have the figures for 2008, but around this time in December 2008, which I'll show you on the next slide, is when the Federal Reserve started to stack mortgage-backed securities. Since then, the mortgage-backed securities market has grown maybe about $4.5 trillion from, let's say, somewhere between 7 and 9 trillion over here in 2008. Let's say it's about 8 trillion or so, to about 12 trillion, or say $4.2 trillion it has grown. In that time that the housing market has grown, or the mortgage-backed securities market has grown $4.2 trillion around, what has the Fed been doing? Accumulating these MBSs to stimulate housing prices, which are now completely unaffordable to your average Joe who cannot afford a house anymore. This is an excerpt from December 2008 Fed H.4.1 release, which is the technical term for the balance sheet. It said here in a note, on December 12, 2008, the Federal Reserve Bank of New York began extending credit to Maiden Lane LLC under the authority of Section 13-3 of the federal whatever, blah, blah, blah. This limited liability company was formed to purchase residential mortgage-backed securities. So that's when it began, December 12, 2008. So where are we now with the Fed's balance sheet and mortgage-backed securities? We are here. This is the most recent release, the H.4.1 release, showing you precisely how much MBS is on the Fed's balance sheet. We have here in this red rectangle that I outlined, mortgage-backed securities holdings of $2,707,446 million. So that's 2.7 trillion out of 12.2 trillion. That is a total of 22% of the mortgage-backed securities market owned by the Federal Reserve. Now, if that mortgage-backed securities is on the balance sheet, and the balance sheet is the asset side of the dollar equation, with the dollar being the liability, then effectively 22% of the value of the US dollar is backed by these mortgage-backed securities, which means when they fall, the dollar falls, which means this. It's hard for people to logically crunch that housing prices and the dollar's purchasing power can fall at the same time. How is that possible? If housing is getting more affordable, shouldn't consumer prices be going down or at least not be climbing? No, because as interest rates go up, even if housing prices go down, housing becomes less affordable because more people are unemployed and it's harder to pay those higher interest payments on a mortgage. So even though housing prices are going down, housing becomes even less affordable because nobody can actually buy one because their purchasing power is falling as food is getting more expensive and other consumer products are getting more expensive also. So what we should see here in this environment, if the housing market breaks, is falling home prices with rising interest rates and a falling US dollar with rising consumer prices. But it gets worse. You see here, more than mortgage-backed securities, obviously, is $5.77 trillion in US Treasury securities. So that is backing, I think, about 60% of the balance sheet. So when mortgage-backed securities fall, it's not the only thing that's falling. It's also the Treasury securities that are falling. Then you have 60% of the balance sheet, about plus another 22%. It looks like about 80% of the balance sheet is backed by U.S. Treasury securities and mortgage-backed securities, which fall in value at the same time. They are linked markets because they're both interest rates. So as interest rates rise and mortgage-backed securities rise, everything is levered to housing, it seems, in the US dollar. So as the housing market buckles, the balance sheet buckles and the value of the US dollar buckles. And the thing is, when these assets fall, the other assets, the real assets on the balance sheet, have to rise. And the Fed does have perhaps some gold on its balance sheet if it actually exists. And that value has to rise to compensate for the falling paper value of the balance sheet. And obviously, most people can't afford gold, but they can afford some silver and they will be buying it, pushing the gold-silver ratio down somewhere around 15-1, the monetary ratio, when a panic takes hold. The state of the COMEX, it's like the State of the Union, except worse. This is the amount of registered silver on the COMEX since 2001. You see here the arrow, this is where silver squeeze began. This red line is where we are now in the registered silver stocks. We had a big fall from about 80 million to right now 72.5 million in the last 3 days. There's been a lot of withdrawals from the registered category, but here's the thing. This amount of silver, this about 72.53 million ounces, is enough to cover 14,506 contracts of registered silver, and open interest as of yesterday, June 1st, was 105,994 contracts. Obviously, most of this stuff is going to clear out or roll over, but the question is how many will be left by the end of the month, and this is an active month. The record, I believe, is 17,294 contracts delivered in July of 2020. If we hit that number again, there's going to have to be a lot of eligible silver taken out in order to satisfy the delivery demand. We'll see what happens in the next 3 weeks. A lot of people say things about eligible. There's a lot of eligible silver in the COMEX, and that's true. There is, according to this chart, 264.64 million ounces. That sounds like a lot, but consider the following. 103,176,253 ounces are stuck in the New York Vault belonging to SLV. That's 40% of all eligible silver in the COMEX belongs to SLV. 103 million out of a total of 264 million ounces. So much of that eligible silver is already accounted for. Am I saying necessarily there will be a silver default at the end of this month? No, I'm not saying that. I'm saying eventually there will be, and it has to be monitored. It did happen once before in July of 2020 when deliveries hit 17,000 contracts. That silver had to be shuttled immediately. I think it was 40 million ounces from eligible to registered overnight. That happens again. The last time that happened, we saw a quick run to over $30 in silver. That was back in August 2020. In July 2020 was the emergency shuttling of that silver. It could happen again this June. We'll see. It is not assured. And there's only so many ways that I can say patience. And that term is very much mocked, but it is still, nonetheless, very much true. Because when you think about it, is this going to be the very first time in world human history that gold and silver did not rise spectacularly in a galloping to hyperinflationary environment? No, this is not going to be the first time. Normal things are going to happen, and things happen quickly once the mentality catches on. It hasn't yet, but give it a few more inflation reports or CPI reports, and it will. In the meantime, make sure that you have enough of an emotional buffer to withstand all the negativity and then some. This is Rafi, the Endgame Investor, coming at you with this week's Silver Report for Arcadia Economics. Hang in there, guys. The crack up boom is coming, and I'll see you next week.